Welcome back. I hope you've completed Objective 1 and Objective 2 and watched those videos and filled out that part of your notes because we're getting ready to move on into Objective 3. So Objective 3 is looking at the accounting equation and then defining these assets, liabilities, and equities. So the entire accounting system is based off this one equation that says assets are equal to liabilities plus equity. This dates all the way back to the 14th century when a Venetian monk named Luca Pacioli wrote a book, really a textbook on mathematics, and he included a chapter in it about bookkeeping. It was radical at the time because it was the first mathematics book that was written in the Italian language as opposed to Latin. So most textbooks were written in Latin, which means only the rich people who had gone to the university could read them. This was written in the everyday man's Italian, and he included this chapter on bookkeeping so that the everyday merchant could keep track of their books, their money, their finances, and he laid out this equation of assets are equal to liabilities plus equity and this concept of what we're going to call double entry accounting. And we've been using it ever since. Now, the key with this equation is that it has to balance. It has to. There is never, ever, 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 ever a situation where the equation would not balance and it be correct. Okay, so that's the cardinal rule is that as the equation has to balance, assets must equal liabilities plus equity always. So an asset is, the quick and dirty definition is anything that we own. Our official definition is that it is an economic resource that is expected to provide a future benefit. So this future benefit is a key part here. It's something, you buy something, anything that you buy that you're willing to spend your money, your time, your resources on is because you expect to get a future benefit from it. Now, sometimes that future benefit is used up immediately, and sometimes that future benefit is going to come days, weeks, months, even years later. But if think about anything that you bought, anything that you spent your money, your time, your resources on, it was because you expected that future benefit. So some of the examples of assets that we have, certainly this is not an exhaustive list. Cash, if it's yours, you own it, that's an asset. Inventory stuff that we're going to sell to customers, goods that we're going to sell to customers. We talk about those more starting in chapter 5. Furniture, land, buildings, equipment, office supplies, anything, again, that you own is an asset. A liability is just a fancy word for debt. So any debt that you have is a liability. The person that you owe that, or the company that you owe that money to, that debt to, is called a creditor. Now, in accounting, one of the things that I say often is that accountants are not real creative, especially when it comes to naming things. So almost all liabilities have the word payable in their account title. And so pretty much it's whatever it is that we owe and you stick the word payable in it. If we owe salaries to our employees, then we have salaries payable. If we owe money on a note to a bank, a note is just like typically a loan to a bank or financial institution, then we have a note payable. Account payable is a kind of catch-all term we use to record money we owe to suppliers. If we owe the electric bill, then we'll have utilities payable. So pretty much anything that we have that we are going to have to pay, we're going to call it whatever it is and stick the word payable on the end of it. And then equity. Equity is the hard one to kind of wrap our heads around here. And part of that reason is because equity is a term that we hear people use, and I don't want to say they're using it incorrectly, but they're using it incorrectly. Or they're using it in a different way. So it has a different meaning than what we mean for it in accounting. So equity is the owner's claims to the assets of the business. Think about it like this. If the business were going to cease to exist They were going to sell off all their assets, use that money to pay off their debts. Then the equity is what would be left over for the owners. It's the amount that is owned by the owners. Okay. Now, really, if a company were going out of business and selling all their assets and paying off all their debt, that is not the exact amount that the owners would get. But that's a different discussion. That's what it is in theory. Now, equity, you'll also hear it called stockholders' equity or shareholders' equity or owner's equity. Remember, those stockholder, shareholder, owner are all words used interchangeably or synonymously, is really broken down into two big categories. The first one is what we call contributed capital. Now notice that's capital with an AL, not an OL like Austin and Washington, D.C. So anytime we see capital with an AL, capital with an AL means money, resources, things like that. So contributed capital is the amount of money, could be resources, could be assets, typically money, that has been invested into the corporation by the owners. In other words, it's the amount of money that the owners have contributed to the organization. So if an investor gave you a check of $50,000, that $50,000 is contributed capital. In a corporation, most often owners contribute capital, money, resources through the form of common stock. So remember, stock is a share of ownership. So basically, when I bought Disney stock, I gave Disney some money, and they in turn handed me a stock certificate and said, "Thank you so much. Now you're an owner." We're going to talk about this a whole lot more in chapter 13, but I just want you to kind of have that basic understanding. So contributed capital is money that the owners have invested, typically in the form of common stock. Until we get to chapter 13, we usually just call this part common stock. Okay. The other half of equity is what we call retained earnings. Now remember, accountants are not real creative. Retained earnings or income or profit that we have retained or kept in the organization. I like to think of retained earnings as kind of like our corporate savings account. So we're going to see the company's going to operate. We're going to get our profit at the end of the year. We get our profit and we have the option. We can say, hey, I'm going to keep this profit in the company, or I can decide to share some of this profit with our owners, and we'll talk about that on the next slide. So the profit that we keep in the corporation, that we essentially think of it like we took all of our profit and we transferred it to our savings account, and we're like, I'm just going to keep this and save it. That's our retained earnings. So equity goes up when owners contributed capital, or it goes up through what we call net income. So net income is our profit, and profit goes up through what we call revenue. Revenue, another word for revenue, is sales. Revenue is the money that we earn. Key word here is earned. Revenue is the money that we have earned from selling goods or services to customers. Okay, so I confess that I do not have a touchscreen computer, so it's really hard for me to write with my mouse, but I'm going to attempt. So our equation up here, remember, assets are equal to liabilities plus equity, right? Yeah, that's an EQ. And equity, we said, is broken up into two categories. One of those is contributed capital, and for our purposes right now until we get to chapter 13, we're just going to call this common stock, which is basically what it is. And then the other half is what we call that retained earnings. That's our corporate savings account, right? So that retained earnings, remember, is made up of those two pieces: net income or profit, and then dividends. So remember, we said when we get our profit, we can decide, hey, I want to keep this, I'm going to put it in retained earnings, or I can say, hey, I want to share some of this with the owners. And when I do that, when I send them a check and I share with them, that's called dividends. So I told you I own Disney. Disney likes to pay dividends. So every year I get a check from Disney for a little bit of money, because I only own a little bit of stock, that has some dividends. It's the amount of the profit that they're sharing. They're like, hey, we've had a good year. Let me share this with you. So dividends are distributions of equity. I pay them out of my savings account, out of that retained earnings account. So they reduce equity. So retained earnings, again, is broken up into two parts: net income and dividends. Now, again, I know this is really hard to read, so bear with me here. Now, you'll notice that I put dividends in parentheses. In accounting, we don't use a minus sign to indicate subtraction. When we're going to subtract something, we put it in parentheses. So I'm putting dividends in parentheses because they're subtracted, or they're reducing the net income, the retained earnings. So net income, profit, earnings are made up of two parts. They're made up of revenue, those sales, the money that we earned from selling our good or service, and then expenses. And expenses are what you think they are. They are all of the costs that we have to incur in order to sell our good or service. And again, we'll define these a little bit more later and talk about them a lot more. So I'm going to put expenses in parentheses also, because those are getting subtracted. So going back up to the top, we have assets equal liabilities plus equity. That's supposed to be an EQ there. Equity is broken into two parts: contributed capital, which we're going to call common stock for the time being, and retained earnings. Then retained earnings is broken into two parts: net income, profit, minus dividends, those distributions of equity when we share our profitable operations with our owners. And then net income is broken into revenue, the money we earn from selling goods or services, and expenses, the cost of selling those goods or services. So again, this is what we call the expanded accounting equation. It's a little easier to read than my diagram that I drew on the previous slide, where we see that retained earnings is net income, or revenue minus expenses, and then minus dividends, and contributed capital is common stock. So if our revenue exceeded our expenses, meaning our sales, the money that we earned by selling goods or services, exceeded the expenses, then we have net income, we have profit, we have a positive number. If the expenses exceeded the revenues, meaning the cost of sales, the cost of selling these goods or services exceeded the amount of money we earned from selling them, then we'll have a net loss, or we'll have a loss. We didn't make a profit that year.